So thank you for coming. So in today's session, I'll explain to you how to develop your own trading system. So give you some ideas and then take notes, and then you can work on each component. And I'm going to create more content on this topic. So later on, you will be able to add more ideas and the things, the aha moments that yes, I can do this. I should be doing this way. So that's my objective. It's a long process. So each slide uh, has a lot of work to do behind. So to give you the idea, that's my purpose, to give you the ideas on what you should be doing and what I do. So laser focus to make my life easy. So developing your profitable trading system. So, um, so these are the three contributing factors towards your trading success, and I keep emphasizing almost in every session I teach that these three are the contributing factors. So these are broad areas where we need to work. And in the bracket, I have written down the percentage, the contribution fact, the percentage, how much it contributes towards our success. So this is a broad topic to just to give you the idea. So the most important factor in our success in trading, especially, and in any endeavor, is me. So I'm the one who's responsible for my success. I'm the one who whatever is the result, I am the one responsible. So how I operate every day in my life, that's the way I'm operating in trading also. So I have certain beliefs, you have certain beliefs, I have certain mental states, and given the situation, I adopt that mental state, and I explain to you a few of the mental state in as we move forward. So it's a 1 hour, 1.5 hour session. And then each mental state have a mental strategy attached to it. So the mental state, the mental strategy, and the beliefs. So I will show you certain beliefs. There is a very comprehensive um, session I have. So think about it. On the topic of beliefs, I have prepared 150 slides. So 150 slides will take maybe 4 or 5 hours to go through. So it's deep down. And this is a big topic. You should be working on it yourself. There are a lot of materials available on Audible, on Amazon, on YouTube, maybe on Google. So beliefs. So I'll give you some ideas. The mental states, mental strategy. So it contributes 60%, and some experts say that this is total 100% is towards your success in trading or in any endeavor you do. The next component, which has a 28% contributing factor, is the risk management. So I'll explain to you. The risk management has two components, that how much and where. So how much means where, how much means how much you need to invest uh, in that trade or in that investment. So it doesn't matter what you're trading, um, in stocks, options. You may be investing in real estate deals, such as trust deeds, where you can invest fractional. So how much? So if there is a deal, $1 million deal, and then let's say 20 units available to invest. So which means $50,000 for 1 unit. So you can buy 1 unit or you can buy 2 unit, meaning invest. So 50,000 or 100,000. So that's fractional investment. So similarly, so in other words, you don't want to risk, even though if you have $1 million to invest in that deal, but you don't want to because there are other investors. You rather spread your risk on different investment. So you say, no, I will only invest 1 unit, and 1 unit is 50,000. So if anything happens to that deal, let's say it's suffering, maybe foreclosure or whatever. So the maximum risk you have in that deal is 50,000. So the same thing, the maximum you have in that trade is a certain amount, which is based on your risk profile, how much of a capital you have, what is your age, how much of risk appetite you have. So this is very important. We need to ask ourselves how much I'm willing to risk. So how much I'm willing to risk is the first question we need to ask in each trade. Some trade, the risk could be bigger than the others. So uh, so based on the portfolio size, based on your risk profile, what else is going on, what's the condition of the market. So it's not a fixed, very fixed amount or fixed percentage. It can vary. So you have to be very flexible in moving up and down. Sometimes the risk is very fractional, like 0.25% of the portfolio. So you start with 0.25% of the portfolio. Then as the position is building up, you may increase because it's looking it's telling you something. Now the second question comes where. So where question comes from the technical analysis, from your trading system, where you will be stopped out. So in trading, where you will be stopped out. So only either you have a predetermined amount that if I put in $1,000, I'll stop out at a 50% loss. So that's my loss. So I will lose $500. So $500 you are willing to lose in that trade. So how much you would invest? Maybe you will invest $1,000 because if you stopped out at 50% loss, then you would lose, let's say $500. So you would invest, let's say $1,000. So $500 is 1% equal to 1% you would invest. So these are the kind of formulas. And then the trading system, whatever is telling you, giving you the trade. So your entries and your exits. So entry is there here, and the exit for the profit is somewhere else, and the exit for loss is somewhere else. So the exit for the loss will give you where you will exit and how much you will lose based on the entry and where you will lose. So this trading system that fits you, so again, the trading system that fits you contributes 12% towards your trading success. So this is the research done or the experts tell us. So 60% of the success come from within us, from us. And it's true because the same trade, one trader makes so much money, one trader lose money in the same trade. And one trader makes average what is expected. So the same trade, one trader is making a big profit, one trader is making the mediocre profit, another trader is losing in that trade. Same trade from start to finish, he end up losing. So what went wrong? Because of the way that trader operated in the market in that trade. So when you add 60, 28, and 12, it comes to 100%. So these are the big topics. So trading system, I have another presentation where I explain 12 trading systems and their combination. So not one you can say, okay, I have one technique which I use and make money. No, it's not one technique. If you deep dive down, then you are using multiple techniques, multiple things going on behind. It's just not one technique. It's not like, okay, one technique, one indicator I bought for $49 and it's making me money. That's not the way market works. So mostly you are involved in it and your risk management, and there are multiple factors going on, multiple analysis going on. That's when you combine that becomes a trading system. So in other words, the most important factor in our trading is you. I'll create another slide where actually I have a course which is an 8-day course. It's only $297 for you because you are here. It's $1997 on the website. So if you are not enrolled, I'm starting soon. In few weeks, you send the message to my team and they will enroll you in my 8-day course. So in 8-day course, this you is also described in very detail because it has many components coming in and affecting you here. So you need to be aware of. And you're doing it right now. We are attending this session. Is a lot of things going on in your mind, and there's a reason why you are here. So it's you. So that 8-day course, if you're interested, send email to mastery@tradegenie.com, and they will enroll you. My team will enroll you. So the most important factor is you. For now, you just understand it's you. There are shadow parts. There are some physical parts of you. There are some other a lot of parts in your life which you don't even know that are affecting you and your trading performance. So think about that. So, and you is affecting with a lot of beliefs. So as I said, there are, I have prepared, so this is a big topic for me and I'm constantly working on it. There are about 150 pages of slides. So 150 pages of slide, which I teach in that 8-day course. So there are a lot of neurological factors, cognitive biases, the you can say the pyramid. I've created a pyramid of beliefs, a lot of beliefs related to environment, related to our capability beliefs, such as I'm capable of doing this, I'm capable of doing that, certain identity beliefs, certain spiritual beliefs. So it just all starts with spiritual beliefs at the bottom. So spiritual identity, value, capability, environment, all that beliefs, and then deep dive. When we deep dive, then we have a trading belief. We have a belief about the market. We have belief about the money. So some of the beliefs, I just to give you the example, I have written down 6, 7 bullets for you, and see if you bring some of the beliefs. And I will show you some more slides on the belief. So beliefs play a role in you factor. So belief come in here. So if I draw an arrow or circle, then beliefs, mental state, mental strategy, all the shadow parts, all the parts, our family members, and all the things which went on from the young since we are born are made us, and all the decision we took in our life is some of all is right now what we are, where we are right now. As I'm speaking from home office, so my office is at home. So, and you are, I'm sure you are in your home or somewhere in comfortable place. So all the decision you made in your life is the result of you listening to me right now, and I'm teaching. So think about that, and whatever we will do tomorrow. So so beliefs. So this, when we are trading, we're looking at the chart on the side. When we look at the candle or bar, we say, I'm sure that candle is telling me something. So by looking at the candle, you're trying to figure it out what is telling you. So it's your belief that by looking at the candle, you will understand what is telling you. So think about the candle. So if you look at the 5-minute candle or 1-minute candle, so what is the candle? So if I put a chart, maybe next time I'll put a chart of a candle, and in case you don't know, the candle has open price, close price, and high price and low price. So that's a bar, any bar. So that 5-minute candle depicts the way, the Japanese way, or you can have an American way of Western way of drawing the bar, or you can have a line chart. So think about it, that 5-minute candle, what it tells you, open price, all the the decision of all the traders who transacted during that 5 minute all over the world. Does not matter, a million shares or 100 shares. And so all the ticks up and down. So if you dissect that candle and you have all the transaction in front of you, it's bunch of dots scattered everywhere. So think about it, all the price dots, and then you can say all the shares amount, the 100 shares, 150, 200, 300, all that, you can put it on the screen. And then the time, and whether that transaction happened, uptick, downtick, whether that was a sell transaction or buy transaction, all that combined is a candle. So think about that. Millions of transactions happened during that 5 minute. Millions of shares got traded at different prices, and we create that into a candle, and we then say that candle is telling me something. So think about that. That's our belief. So is I use candle, but alone one candle is alone is meaningless. in isolation. So that one candle is meaningless in isolation. We have to evaluate the candle in terms of the whole landscape, what else is going on. Similarly, I'm sure stochastics is giving me sold out reading. So traders use the stochastic for oversold, overbought. So the market can be overbought for a long time and it can be overbought. So right now, all the market, the Dow Jones, S&P, and Nasdaq, they are making new highs and they are overbought. So you will hear the market is overbought and we need to go all cash. Well, we don't know when the market will end. The trend will end whenever it wants to end. So whenever. So we don't know. So if we are using a stochastic, it's telling us, and if the market is tanking, we are saying, okay, stock market is telling me the oversold, and this market is about to move up. That market can go down for a long time. I'm sure this moving average will hold. So what is moving average? Moving average is just the average of the prices. So there are hundreds of ways of creating moving average. Simple moving average, exponential moving average, weighted moving average, what is it? Adaptive moving average. Then there are moving averages based off moving average. There's a moving average of moving average. So 21-day moving average, 20 moving average, 50-day, 100-day. So some traders, they use moving average as a ribbon. So they don't even know how to color that moving average on their chart. So wait a minute, is it a 50-day or 100-day, 200? Because they have purple, blue, pink, like rainbow color, and more than that. So if you are using moving average, the market out of all that moving average has to trade on that line. So think about it, has to trade on that moving average. If it's not holding 20-day, maybe you have a drop down feature and then you up it a little bit, and then you say, no, it's not 20, it's 21-day moving average. So I'm sure this 21-day moving average will hold. So why the market will hold that 20-day moving average? Just because we think that on average it takes 20 days for the market to pull back, and then it will hold, and then it will break out, and I better get in when it touches 20-day moving average. So that's we bring our beliefs. You see, I think market will tank soon. One of my friend, I met him long time along with another friend about before Christmas break. Like just 2 days before, and he said, you know what, Nashi, market will tank when the market will open after Christmas. So I said, how you know? I have done the study. The market is about to tank, and wait and you see. So the market made a new high and not a tank. I'm sure market is telling me something. I'm more successful in downtrending markets. So traders only trade one side of the market. They miss out the other side of the market. We should be able to trade both sides of the market at any given time. Like Robert De Niro in his movie Heat telling Val Kilmer that you should be able to leave the town in 30 seconds when you spot the heat. So that movie is a great movie. I watch it many times. It's on Netflix. You can watch Heat by Robert De Niro and Val Kilmer and Al Pacino. So top movie. So maybe we can learn some lessons from that movie. So I'm more successful in downtrending market. So you miss out the other side of the market, or you only trade some traders, they cannot trade the downside of the market, only trade on the long side. So if you're trading only the long side of the market, maybe one system is enough, or long side. But then you should be able to, when trading on the downside, you should be able to flip your apply that trading system to the inverse symbols, the symbols which go down, go up when the overall market, general market is trending down. So what are those symbols? So inverse ETFs, maybe you know that, okay, when the market is going up, I need to trade this market, because when the market is going down, this market goes up, so I better trade the other market. I'm sure T-bills are going to have a major correction shortly. So all this, we bring our beliefs. So we trading our beliefs in the market. Every day we bring our beliefs in the market. That's why we have both sides of the market. One is selling, one is buying. So we are trading our beliefs about the market, whatever market we are trading. So think about that. So we need to understand the market at any given moment, at any day, any time. We have to understand what the market is doing. So I look at the market every day. As soon as the market, before the market opens, I look at it. I've done the analysis nighttime, and then when before the market, I watch the futures market. I know where the market will open, and what will tell me that the market is holding the level and it's improving. So the market is improving from the time, the 30 minutes of the time market open. So I live in San Diego, so 6:30 a.m. Pacific. So from 6:30 a.m. to 7 a.m. So if the futures were up, and I know where the market should open. So when the market opens, and then what happened to the overall market and during the first 30 minutes. So I write down the levels. That level should improve if I'm expecting the market to move up. If the levels are not improving, if there's not enough participation, then I know that the market is kind of choppy, neutral, not enough strength, or the market is just holding the level, and maybe I have some open position and I need to take care of that open position. I shouldn't be holding it for further gains during the day, because the way the market opened, I already have gain. I need to log the gains. So lot of other factors go on when the market open, depending on and what position I have and what I am looking to open a new position. So market, so there's a bull market and there's a bear market. So that is a very big definition of a market, a bull market and a bear market. But within bull and bear, there is a downtrending market. So in bull market, there's a downtrending market. In bear market, there is an uptrending market. So as a trader or swing trader, even if you're long term, unless you are long term and you don't want to sell, you just always stay in the market and you add more to the position when the market is going down, then you should be happy. So when the market is going down and you're a long term trader or investor, you should be very happy that the market is going down, unless you are 80 plus, and so you shouldn't be in the stock market. So maybe you're in the fixed income market. But if you are not going to retire and you're not dependent on that, uh, you know, extracting the money from the market, we should be very happy when the market is going down, because that gives the opportunity to dollar cost. So most of us, we freak out when the market is going down. We should be very happy when the market is going down if we are a long-term investor, because you can average down your 401k, your retirement, your IRA, your Roth IRA, and your portfolio. You have the opportunity to buy more of that same thing when it's down. So if you think Apple is going to $4 trillion market and Apple is tanking and is trading at let's say 180 level, and it made a high of 199.60. So if you think Apple is a $4 trillion and you are in it for the long haul, then you should be very happy to buy more at 180. And if it goes to 150, then you're even more happy, because overall long term you think it's going to 4 trillion. So 4 trillion, whatever is the price of the Apple, will be maybe 5 trillion. Why bother 4 trillion? Make it 5 trillion. So Apple is very attractive when it goes to 150 rather than 200. So 200 will, if you're in Apple and it's at 200 or 225, then okay, whatever investment you have, you're making money. But if it goes to 150, you should be very excited and say, okay, this is my opportunity to buy more. So that is a bull market and bear market. So, so what I do in my analysis, and I mentioned that this analysis is available to you for just for 97 for the whole year. So if you are interested, send email to my team at success@tradegenie, and they will hook you up. So what I do in my analysis 5 times a week, I analyze the whole 4 different markets: the Dow Jones, Nasdaq, S&P, and Russell 2000. So the way I analyze, I do the top-down analysis and then the bottom-up analysis. So top-down analysis is the individual indices. You put the Dow Jones symbol, like dollar Indu or whatever, dollar SPX, and you analyze it, and then come up with your decision. And then, or you can analyze, let's say Dow Jones have 30 components, so you can analyze those 30 components bottom up, each individual component, and then come up with your analysis, and then you say what is the situation for Dow Jones. So that is a bottom up. So I do bottom up and I do the top down both. And then I do the analysis. So I do these analysis, and I will explain to you. So the analysis is done not only based on the trend. So you have to do the analysis of the trend. So the trend, so I define the trend into three different components or three categories. I call it a major trend, intermediate trend, and then the minor trend. So minor trend is the week to week fluctuations up and down. So for last 1 week, the minor trend was down, is weak, and now on as of Friday, it has shown its strength to the upside. Whereas the intermediate trend and the major trend, so intermediate trend is 2 weeks of overall market performance. Based on that, I analyze, and the intermediate trend is to the upside, and then the major trend is it depends what happened during the first 2 weeks or more than 2 weeks. Then I categorize that major trend as an uptrend. So major trend, intermediate trend, and minor trend. So now when the minor trend gets weak, then I'm on an alert. Then the minor trend is getting weak, which is weekly trend, and it can build into the intermediate trend and the major trend, and overall the market just start to tank. So I do all this analysis 5 times a week. And then also we need to do, so the trend could be the market can be moving up but is very weak, or the market is moving up, is trending up but is weak, and the uptrend market which is weak can turn into a choppy right away, or whipsaw, or a false move. So not only we need to monitor the trend, whether it's to the upside or downside, but we need to monitor the strength of the trend. So I categorize this into 6 and put it in a barometer kind of format, with needles. So the very strong, mildly strong, and then the neutral, and then the weak, very weak, and mildly weak, weak, and very weak. So knowing all this gives me the idea that which way I need to put my money, more money into the market. And then there is a volatility analysis I do, whether the market is volatile or very volatile or quiet or normal. So the money, and then based on all the past history. So you have to do and if you have not done it, and I'm telling you in summary way, what happens when the market is uptrending, the market is not volatile. The volatility is normal and quiet. The market moves up in a quiet, normal fashion, and it has been doing it since November 1st, and it has not shown any sign. It was a week starting 28 December till Friday. It was the market was kind of weak and choppy, but now it has gained its strength again on Friday. So the volatility, if the market is trending to the upside and the volatility is quiet, then that's the best time to stay in the market. And when the market is downtrending, then the market becomes volatile. So if we are trading any market, any symbol to the downside, we have to know that it's volatile, and it can change its mood. It's like moody. It can change its mood overnight, and we need to be quick. So, and the reason it is that there's some good news come, some bad news come, the market tank, and then some good news come, the market goes up. And not only that, not only the good news, but there are traders or investors who think it's a fair value. So they come up and buy, and our downtrending position lose. So for the downtrending market, um, the position is to be hold for short duration. And then there is a sideways market. So doing all this analysis, understanding who I am, where I came from, my financial obligations, my objectives, my beliefs, my mental state, the strategies I'm using mentally, and the resources I'm accessing mentally, not only the resources like platform or charts, etc., but the mental resources based on the experience, etc., and the mental strategy I'm using, or the mental state. So sometimes the mental state could be the confidence state. Sometimes the mental state could be the patience state. Sometimes I'm aggressive. Sometimes I'm very calm. has to be calm, but just starting the position in a very small, portion. So all that combined is a component. You can say what the combination of. I will show you the chart. Combination of market and you. So this slide tells you $97 for the whole year of market trend service. So it's $8. What happened is this, based on this analysis, every day I know that I need to increase the exposure in the market or decrease the exposure in the market, and what is happening in the market, so I can take care of my open position, or when I'm opening a position, what I need to do on which side. Maybe for a few days I need to trade on the short side, selected symbols, and take some money from the short side, and the rest of the time I'm trading on the long side. So this market analysis is available to you for 97. It contributes towards your success. So send email to my team at success@tradegenie, and they can enroll you. So next, so this is, if we draw the Venn diagram. So Venn diagram, this is overlapping. So Venn diagram tells you where you need to focus. So I explained to you. So this is you. So you is very complicated person. So you is very complicated. On the other hand, the market is also very complicated. So think about it. You are a very complicated person. You're the one unique out of 8 billion. So you're very complicated. Market is very complicated. So imagine two big components of your success are they're very complicated. And so not all kind of market is suitable for everybody. So for some traders or investors, they only want to trade uptrending. For some is a sideways. For some is downtrending. So think about that. And it's you. So combine. So laser focus on that kind of a market which is suitable for you. So imagine 8 billion people residing here in this universe, 8 billion. And out of 8 billion is unique you. And so many kinds of market and so many variables in the market. There are 9,000 plus symbols in the market. And so think about that, 9,000 symbols here in this market. There are 8 billion people here. So only you is unique, and there is something about the market, that particular type of market is suitable for you. So wherever is that overlap area, that's your focus. So think about that. So this helps in developing our profitable trading system. If we don't understand ourselves, if you don't understand the market, then we are all over the place and we don't know what we're doing. So just come in the market, open a Robinhood platform. So think about the Robinhood. It went up. It started at $85 when IPO, and right now like $8, $9. So think about when the Robinhood they launch and IPO, and before that people open their account at $500, $1,000, $2,000. They all became what like a feeding to the like a little diet for the big boys. They want you to open an account on a platform such as Robinhood. The big boys want you to bring your money, $2,000 or $500 or $1,000 into these brokerage accounts. Download the app, and they created no barrier. They created no barrier in doing such, because if you don't bring the money, if we don't bring the money, how they will bring the money, how they will make the money. Imagine all millions, 1 million traders. Think about it, 1 million people bring $2,000 each. So how many? $2 billion. 1 million traders bring $2,000 each, bring $2 billion into the market, and it gets gobbled by the big boys. And they have created no barriers. Anybody with the $2,000 available in their account, they can download the Robinhood, download the software or any other software. I'm giving you Robinhood because then you start trading in 2000. So that's what I did 15 years ago. When I started learning at that time, there was Option Express. If you been trading 15 years ago, you know Option Express, which got bought by I think E-Trade and then Charles Schwab, etc. So that's what they told me. Hey, you open an account with Option Express, $2,000, and use my scan and software and start making money. So in one trade, I made money, and then I made some money in another one or two trades, and then $2,000 gone. So I had no idea. So you and the market. So laser focus on that on that this area. So after understanding all this, you have to spend time in understanding all that. It's a lot of work. Then you move on to say, okay, I understand myself, I understand the market, and this kind of market suits me. So now I go and buy books on Amazon, and so I did. I was part of the Yahoo forum at that time, and I created my own Yahoo forum later on called Noshi Trader Group. So there's a long story, and then I'm talking to you right now. And so I created uh, different websites and finally decided Trade Genie. So there's a long story behind. So I started learning, and I said, okay, what I need to do. So I met few people, and then I am very passionate. That's all I do all day. All day. Even on Sunday, I'm teaching you the whole day. I learn something. I spend time in learning and improving and communicating with my team and doing the research and teaching you right now. So while I'm teaching, I'm getting the ideas. So 12 trading systems. So I will give you the list of 12 trading systems I use, and then there is a separate session in little detail about the breakdown of each system. So what you need to do is by trading system, whether you master the visual, the chart pattern, or the candlestick pattern, or the breakout system, or the gap system, or the reversal system, moving average, band trading, whatnot. Maybe you buy some indicator and it's you call it a system. So you develop your system. So just the broad definition, so which you can turn on and come to the market, and you can look at it, entries and exits. So in order to trade the market, we need to have at least minimum two kind of a trading system, which is one is for the long side and another one to the downside. So imagine, so one for the long side and one for the downside. So at least we need to work. So we sit down and then we say, okay, I master the long side first, because that's my natural. People want to, it's our tendency that we are excited and everything when the market is moving up. When the market is moving down, then we are not excited because we see our portfolio has gone down. So develop two kinds of trading system, which can gives you the entries and exits, one on the long side and one on the short side. So I will explain to you what are the two, or what are the 12. I will give you the idea, and then I have another session. I explain the breakdown, and then you can work on developing each. So at that time, so what is the criteria for developing? So you can have one system which gives you one trade per year, and that is a very highly profitable trade. So you don't want that kind of system which gives you one trade per year, and if you miss it, you miss it. Then you wait another 1 year to come up with the system, and then it's highly reliable. You say no, it comes once a year. That's a particular head and shoulder pattern I master, and when I see that, it's work. And it happened that when it showed, you were walking the dog and you missed it, or it so happened it failed at that time. So it failed at that particular time. You waited for 1 year and it failed, or you didn't catch. So you don't want that kind of system. You want a system which gives you the trade, if not every day, every other day, etc. If you're a swing trader. So that's another one criteria. It's reliable. So you need to be, it has to be like overall your win rate is high, and the percentage gain is high, not only the win rate. So don't just, so people send me email, what is your rate? So that is a very naive question. When you ask someone what is your win rate, that's a very naive question. So don't ask anyone. If you're approaching someone, say, hey, what is your win rate? The win rate can be 99%. I can say, oh, my win rate is 99. um, um, so, and then only one, so you say 99? Yes, 99, and only 1% loser. So then if you ask me, Okay, can you give me some more information? Then I say, okay, I made $1 in these 99 trades, and the last one, the loser, I lost $100. So I made 99. In 99 trades, I was the winner, and I made $1, so I made $99. And one trade, I lost $100. So that is a losing system, even though it has a 99% win rate. So don't ask anyone what is your win rate. You have to, again, it doesn't matter what the person is saying, because, and the reason uh, is you. This is the reason that even though a trading system which is 100% win rate has a 100% win rate, but because it's you may screw up and you turn it into a 100% loser, or you may put different uh, money in it. Instead of putting $1,000, you ended up putting $10,000 because you got excited. Instead of putting a 50%, let's say, a loss, you did not put 50% loss. You did not get out. So this risk management, this all contributes towards your success. So only the trading system, which is very profitable, doesn't work. It doesn't work. You need to know what else is going on. So it has to be reliable. It has to be consistent. So it's not like once a year. So don't develop your system which is once a year. Have to have a regular candidates coming into you, trading candidates. Reward to risk ratio is really nice, and have some win rate, proper win rate, maybe 50%, 60% win rate. So even if you have a system which you are only profitable 50% of the time, you can make a lot of money. So think about that when you're creating a system. Put these things in mind. Not only this, then the other question we need to ask is, there's another slide I have, is what is your scaling in strategy? What is your scaling out strategy, etc. So just you see a symbol, it shows it's going up, then what? Then what would you do? So it's there, buy this. So then what would you do? How you will scale in to make a very profitable trade? And how would you scale out? So all that goes into developing your system. So consistency, frequency, reliability, reward, and then after that is your scaling in, your scale out. If you exit from the trade, for some reason, what will tell you to get back in, you got out early, etc. So all that factors go into creating your system. So now so there are two components to anything. Yeah, so you can develop your low risk trade idea system, and I'll explain to you the definition of this, and then you have to execute. So I can create a system and I say, okay, I'm using this, and take my document and run with it. But then you're unable to execute because it's not fitting you. So in my earlier days, the traders or my members or the group I was in on Yahoo forum, and then I created my own forum. People send me the trade, and I just cannot. When I plug in that trade on the chart, and I don't see anything. So it happened. My mentor named Chief. So he was a native Indian. He called himself Chief. He was like very good in trading. So he used to post his wisdom on the Yahoo forum. So I started learning from him, and then I asked Chief, "Hey Chief, can you send me something which you are trading so I can ride along with you?" He said, "Sure." So he sent me the trade, Home Depot long, 1,000 shares, and I look at the chart and I don't see anything on Home Depot. So I just remained quiet. And 2-3 days later, he said, $3,000 here, LOL. So immediately, what would you do if you don't ignore and then somebody comes back and say, okay, $3,000. So I look at the chart and I see Home Depot up. So I said, wow. So I said, Chief, okay, can you send me another one? And at that time, I was a consultant, but working, like it was like my hobby. So I opened my trading platform during the break, and he sent me another message, and I look at it, and then I shut it down. I don't trade. So he sent me another trade, 1,000 shares here. 3 days later, he sent me the message, $4,000 profit, LOL. So I started asking him, Chief, what is going on? So he started explaining to me, and I became his online student. And finally, I met him one time, and he retired. He gave me all his books and videos, etc. So handwritten notes he had. He gave me a cassette tape cassette tapes, and I did not have a cassette tape, so I had to buy a cassette tape to listen to all the recording. He gave me a VHS tape. I did not have. So I had to buy a VHS player to listen to all that tapes, etc. Anyway, so he explained that you need to develop low risk trade idea and execute low risk. So development is one, and execution is another area. So what is the definition of a low risk trade idea system? So this I learned from the experts, and here is the paragraph from the teaching. So I explained to you that it has many keywords. So pay attention to the keywords, and then when you're developing your system, to pay attention that are you looking into consideration. So the definition, so low risk is not the it's like 5 cents loss. That's not the definition of low risk. So it's something else. So a low risk trade idea is an idea with a positive expectancy. So here is a keyword, positive expectancy, that is traded at an exposure level. So this is another keyword that allows you to survive. So another keyword, the worst possible contingency. So this is another keyword. In the short run is another keyword, so that you can achieve the long-term expectancy. This is another keyword. So in other words, you develop a system which gives you the trades, visual chart pattern, and I will show you, list down the 12 possible system for us, that when we take the trades based on those systems, overall we come out to be winner. So if let's say 10 trades are generated on any given day, so you can qualify those 10 trades. Let's say the 10 trades coming in is not perfect system, so you qualify them through a lot of other your human interactions or human judgment, and you give the score, and you say out of 1 to 10, I score it 9 and 10. 9 and 10 are the best one. So when I get number 9, I take it, and number 10, I take it, and then others I ignore. So overall, then you come to know that the one I'm ignoring are really not. They were not a good idea. So you know, and if the one you're ignoring and they are proving to be right, then you have to go back and ask yourself, why did you ignore? And the one which scoring high, then you have to, even though it's scoring high, you have to deploy the risk management. Sometimes we score it high, our confidence level is so high in that trade, and that's whenever our confidence level is so high, we make that trade into a loser trade, because we get overconfident and we over invest. So keep that in mind. So again, human, so positive expectancy. So let's say overall positive expectancy. If you take all the trade, the net result is positive. The keyword is exposure level. So we when we are investing, we need to know our maximum exposure level, meaning if our portfolio, let's say, is $100,000, and we want to risk only $1,000, meaning we are willing to lose only, no. So you have a portfolio of $100,000, and you don't want to lose more than $1,000 in any given trade. So which means your risk percentage for that trade is 1%. So at any given time, you're willing to lose only 1% of your portfolio in that trade. And based on $100,000 portfolio example, it means you're willing to lose only $1,000. So that is how much you're willing to lose. Then the question comes, how much you should be investing. So that is the question you have to ask: how much you are willing to invest, knowing that you will lose, you're willing to lose $1,000, knowing the portfolio size of 100,000. So how much comes from the stop level? So if the stop level is such that when the trade goes against you, you will lose 50%. So it means we can invest $2,000 in that trade. So when the 50% stop loss hit, we will lose $1,000, And because our portfolio size is 100,000, we will lose 1% of our portfolio, which will not hurt us. So what happened, we lose the traders, or we don't survive, or we don't achieve the result because we are not monitoring our exposure levels. We are getting greedy, we're getting excited. Our confidence level is so high in the trade because we heard something on the news. And think about it, there are a lot of sharks out there. So if you want to read about like, I'm interested in reading all those things going on in the financial world. So just now I finished one book called Black Edge. So you can read about Black Edge, um, uh, you know, Ratanatam going to jail, what happened, and then SSC Capital, Stephen Cohen thing. So you would know that how the big boys are operating in the market and what is happening in the market. And we get excited when we look at the chart and we increase our exposure level so high, we go all in. And then that's the trade. Sometimes we make money, and sometimes most of the time we are losing money. And losing money is because it's the trade may work out at the end. So it may work out. But the problem is that when it goes against us, because we have such an exposure level, that it shows a big drawdown compared to our portfolio size. So when it shows a big drawdown in the portfolio size, the trade itself is not bad. It's you expose yourself in a bigger level compared to the level you were supposed to. And that exposure level comes from the greed, the impulse buying, the news in the media, the way the big boys operate, and they are, they show that something is worthwhile and is going up, and they are the one who are dumping. So all that goes on, and we lose money at the end of the day, or at the end of the week, we wipe out our portfolio. So be careful about the exposure level. So if we are careful about the exposure level, if we have a system which is giving us the positive result overall, so if we have a proper exposure, we can survive the worst possible contingency. So what is the worst possible contingency in any trade? It is 100% wipeout in that trade, especially if it's an option trade. So if it's an option trade, it's 100% wipeout can happen. Just you bought something for $5 yesterday, tomorrow the news comes out and the stock tank, and you don't have time to even recover from that option. So 100% contingency. Or you set the stop loss at 8%, 10%. So that was a normal, if you're trading stock, that's a normal 8%, 10%. The stock can go down and then it can make a new high. So that is a normal stop, 8%, 10%. But what if the stock gaps down and goes to 20% drawdown? That particular trade, 20% down. So from 100, you bought at 100, and your stop was 90, which is 10%, and then it gapped down to 80. So even if it gaps down to 80 and you're losing 20%, that one particular trade should not affect your portfolio in the short run. So think about this: exposure level, worst possible contingency in the short run, so that you can achieve the long-term expectancy of the system, because you have tested it, your ideas are working perfectly fine. If you bat a single, and once in a while you get the home run, which is very good. So you're not aiming for home run, you're aiming for single, and overall your portfolio grows. So keeping that in mind when we are developing the system. So far, what we covered that is you have beliefs, mental states, mental strategies, all the components affecting us, the shadow parts and all the other physical parts, our family members, the market ties. Market is very dynamic. Then the trading system, which is one for the long side, one for the short side, and there are many kinds of systems. And then applying the risk management level, then we coming up with the trade ideas every day. And then after trade ideas coming in, now comes the execution. So execution also based on our trading rules. So even though the trade coming up on the screen, it doesn't mean we need to take it. We have to do certain, unless you are fully automated. Everything is being driven by your machine. So if you rely on that machine, is perfect. You have an edge over other traders who don't have such machine. So think about that. If you have a machine which is trading for you, you have an edge over other traders who don't have that machine, because human element is gone. And so you sometimes the machine goes crazy and it doesn't understand what is happening in the market. So you may end up losing or wiping out completely. So it can happen. You can wipe out yourself completely because the machine doesn't understand all the other variables, because the machine or the programming has not taken care of all the thing the black swan event can occur, or one domino falls and another one, then another one, and then total wipeout. So there are a lot of $1 billion funds have gone bankrupt, and that's why we see a sudden crash in the market, because somebody is going bankrupt in a big way. In a big way, somebody is going bankrupt. So trading rules and checklists need to be developed during planning process. You need to have an edge in the market. So ask yourself why you should make money. I mean, who are you? Open account in Robinhood and open with $2,000 and start trading Tesla. Why you would make money? What is the edge? Who are you? Ask yourself, who am I to make money from Tesla? Open a Robinhood account and start buying weekly options. Think about it. Who are you? Do you have any edge, or do you wake up in the market and then a market open at 6:30 in the morning, and then you come at 9 o'clock in the market and open the your platform and see what is going on, and you push the button and buy like weekly option for 50 cents, and then you think, okay, when it goes to $1 and you will close the trade, it will go to 0 cents. So think about that. Do you have any edge in the market? Do you have a systematic way of capitalizing on your low risk trade ideas? Do you have that? Do you have a process of stocking the trade to control risk so you can decrease? So if you lose per unit, you lose less. And when you lose less, when you know you can lose less, you can increase the size of your trade. So when you increase the size of the trade, like per unit, instead of buying 100 shares, you can afford to buy 200 now, because you increase the per unit loss. So when you exit from that trade profitably, you will double your profit or triple or 150% gain, more than what you originally planned. So do you have a stocking process? Are you very precise with your entries and exit? So exits. So now exit, the entry could be one criteria. You see a breakout, 20-day moving average breakout, you buy it. But then where is your exit? Do you know where is your exit? If the stock is making a new high, how do you determine it's trading at a new uncharted territory, like the market right now trading at uncharted territory, right? The new highs. So that's where the traders, they don't understand. When the market is trading, they cannot plot, they cannot understand. So it's easy. So think about this. It's easy to trade the market which has traded in the area before. So you know the path. If I have gone from San Diego to San Francisco, it's easy for me to go back and forth because I know, or from San Diego to LA. But if you ask me, Noshi, can you go to Colorado from San Diego? Well, I can, yes, but I will lose my mind multiple times. Imagine the time when there was no GPS. I'll take a lot of detours. I will ask people for the direction. I remember the day when I had to open a paper map in the car and then, flip it and open it and see where which exit I need to take. And even in the GPS days, I lose the exits. So imagine that, the multiple exits. So the top traders or the people who are professional drivers, they know exactly where they need to exit. So I when I'm traveling somewhere or even driving, when I start, even though I have gone there 10,000 times, I put that destination on my GPS, because GPS tells me speed check, hazard, this is the time, this is the detour, or this is the time you will arrive. So especially when I start my journey, I say, okay, what is the time it's telling me that I will arrive? So it's telling me you will arrive at 6:04 p.m. So then when I arrive, I see myself, that did I arrive at 6:04 p.m.? What was my efficiency level? Oh, I arrived at 6:04 p.m. So I lost 1 hour. So what did I do? that I lost 1 hour. So I took that exit. I stopped at Starbucks. I went to the gas station, or I just did something, pull over in the parking lot, or there was a traffic jam, etc. So same way, you know where your entry is and you know where your exit, but the exit can be a very different time and the price. So, and then there could be multiple criteria for exits. So in another session, I'll explain what are the different criteria for your exits. I listed about 25 criteria. So the exit protocol can trigger, but then you have to adopt a certain mental state. So think about that. Again, when the exit protocol triggers, then what mental state you adopt at that time that you know that you have to exit from this trade for whatever reason. Is it a profit reason, or is it a loss reason, or it could be a reason which is no longer valid for your trade and you need to exit. But then what you do to yourself that you have to exit. So do you remind yourself that, okay, I need to exit and I need to go into this mode, and I have to, when I go into this mode, then a certain process triggers, and then I have to follow this process step by step. Okay, I need to flip the chart, and into this time interval, I have to look if there is still a buying going on. I need to exit or not, and what else is going on? What else is going on in my in my portfolio? What is going on in the market? So all that is we have to remind ourselves. So executing the trade ideas flawlessly, playing the trading game perfectly, monitoring open trades in a detailed manner, and being very aware of market conditions throughout the day. So that's what it takes to succeed. So just not having some system telling you, but the execution execution is more important than the planning. So now think about this. We talk about the market and then the trading system. So if we draw the Venn diagram, so there is an overlap area of the market and trading system. So this is the overlap area. This is where you have to laser focus to create an edge in the market. If you are all over, you don't understand the market, you don't know what kind of a system you need to use, you are just everywhere and you're not laser focused. So think about that. So this is kind of nucleus core. So I'll explain the nucleus part. So this is like a core for you. So this is the core. So this is core, is you there, the market. So you, 8 billion people there here, and you're one unique person. Market, so many kinds of markets and so much going on, so many kinds of trading system. So when you combine, when you draw the Venn diagram, so this become a core of your trading. So think about that, keep that in mind. Now, so many traders have different trading horizon because of the age, the financial situation they have, it's just they like some traders, they like to scalp trading, some like day trading, some swing, some position, some long term. So think about it, what kind of a trader are you and what kind of a trading horizon? So if you're a scalp trader, your horizon is only 2 minutes, 5 minutes. If you're a day trader, your maximum horizon is for that day. You have to go cash. If you're a swing trader, your horizon may be from 1 to 7 days. If you're a position trader, your horizon is 14 days. If you're a long-term trader, you're a long-term trader, maybe forever. So you just investor. So it's okay. So now think about this. A trader, a person on any given day can be wearing different hats at the same time. He can be a day trader, and simultaneously he could be a long-term investor. So on one hand, he is a long-term investor, he's putting some money in his retirement account or a long-term account, and on the other hand, he could be a day trader or he could be a scalp trader. So in other words, he's wearing a different hat and adopting a different mental state. So not only that, a mental state, the trader or investor, he has a different account. He's not mixing his day trading into 401k or a IRS account. He cannot do that. So it's a different account. So think about this, how complicated it becomes if you are doing this. You are opening an account for your day trading, and you're opening an account for your long-term trading, invest retirement account or something like that. So you have two different accounts and you open it, and then you have to adopt a different mental state for your long-term trading and your for the day trading. And not only that, if you're trading stock and you're also trading options, and then somebody tells me, I met someone and he said, oh, I trade stock, I trade options, I'm a small cap trader, I do forex, I do futures. So I look at him, I said, just during the given day, yes, I do that in one day. So you have to be very expert in doing everything in one day, and you need to do in a different account. If you mix one thing in one account, then you are creating a disaster for yourself, because you will overlap, go into another allocation. If you have a, what happened is we open an account, let's say for 25,000, and we say, okay, 15,000 for stock, 10,000 for option. Then we get carried away. We from 10,000 option, we go into $15,000 option and leave 10,000 for stock. And then we go for 20,000 option and only 5,000 for stock. And then by the time we realize we are $25,000 exposed in option, and there's no money left for stock trading. So think about this. So your trading horizon also determines who you are and what you're trying to achieve. So then, so all that, you market, trading system, what is it, trading horizon. Then you say, okay, I need to, so you need to have develop some trading strategy. So the trading strategy comes up from your skill you have acquired over the years. Your trading horizon I discussed right now, your account size. So a trader who has $1 million account can adopt a sophisticated trading strategy, selling naked put, doing verticals, iron butterfly, this, that, and buying, doing covered calls, or right, all that kind of thing that trader can do. But if a trader has a small size, he cannot. He can just trade maybe options. So and the expertise. So you may have $1 million account, but if you don't have a skill, you cannot do anything. So in terms of trading, so or investment, so skills, trading horizon, account size, how much time you have available. Some don't have time. They rather do they go and do the golfing, or spend time with their grandkids, so they don't have time. Some use leverage, and some have a bigger objective. They're shooting for the moon. So if you're shooting for the moon, you say, okay, I open an account with $25,000. I will trade option, and I don't care if I lose all 25,000, but I want to make 1,000% gain by the end of the year. So you're shooting for the moon. Whereas another trader, he said, no. My maximum drawdown is 15%, and I'm targeting 25% gain in my portfolio. So you see, different traders have a different, so they will adopt different trading strategies. So only you know who you are and what kind of a trading strategy you will adopt based on your account size, horizon, skill, objective, leverage, availability of time. So think about this. This is a big universe. So keep this in mind. So now, if we bring market, trading system, and trading strategy, then you're going more narrow, more focus. To think about that, you're going into more focus, because not all trading system may be fit for your the strategy you want to adopt, or the strategy you want to adopt is not fit for the market at that moment. So your strategy will not work for that kind of market. So think about that. So now, the last part in your developing the system, you shouldn't be trading, or at least I don't trade the 9,000 symbols over there, or 20,000 symbols. I don't do that. I pre-qualify the symbols which I want to laser focus. And then during the market, when the market is running, on the other hand, I do look at other symbols, and from time to time I catch a good one, and I do the analysis, I qualify them, and I put it in the basket. So I do that, or I delete a symbol from the basket if it's not worth watching. So I just delete it. I just delete, just delete it. No, not worth watching. Or I'm always looking for a new symbol to add. So some of the criteria maybe you can adopt is a liquidity. How much is a trade 1 million a share? It's kind of volatile because I'm trading options and I'm a short term. I can do my technical analysis, so it has a 2 year of data, because I cannot read a chart which doesn't have a data of less than 2 years. So I can read a chart which has a data of only 3 months. How can I? I don't know. I need minimum of 2 years. The more, the better. Fundamental analysis. So I can do some fundamental analysis. I can do some market analysis on it. I can do some option analysis. It has a proper spread, or the open interest, or the volume, and it's very active, and other traders are involved. Maybe it has a weekly option, it has a standard option, it doesn't have a non-standard option. The strikes are narrow, so I can focus on those kind of trades instead of something crazy. So I don't want to. Sector analysis, news and catalyst, those symbols which are always in the news, there's a catalyst going on. I can see the price pattern. I can read the volume pattern, absolute volume, relative volume, and I can do the proper risk to reward ratio on those symbols. So after analyzing all that, I create the basket. And now once I have a basket, which I have, then I just add a new symbol and delete a symbol. Sometimes I just delete it. So doing that, so think about this. So this is a trading symbol. This is the universe. So this is the universe of, let's say, 9,000 symbols. So you cannot focus on 9,000 symbols. I mean, it's a recipe for disaster. If you are trying to find a symbol to trade out of those 9,000 symbols, and somebody is telling you that, look at here, this stock spiked and we saw this. So you ask yourself, this person, hey, mister, tell me, did you really catch it at this time? And how many shares you traded, and where was your exit? And how many times you have done this? If he's saying only one time, 2 times, he showed the. So no. I want consistency. Did you really? If you're showing me the spike, are you telling me that every time you see there's a spike, you get in? So the answer will come no. It will not. No, it's just, you can go to any trading platform and see the symbol is spiking and say, okay, look at this, it's spiked here and you could have made so much money. That's bullshit. So ignore that. So now trading symbols. So if you have a universe of 9,000 symbols, so you do some work. It's not hard, and I will show you some symbols, some example. So based on the liquidity, volatility, and if you're trading options, whether they are optionable and they are in the news, when you apply some of the criteria, out comes selected symbols, maybe 300 to 500. So 300 to 500 symbols come on the other side. So now those symbols come and you prepare the basket. Now then you say, okay, it's still 300 to 500. I wish there's a way that I can further categorize these symbols so that I can focus. So because I play chess, and I play chess with my kids. So chess is a very important game, and I play with kids. So recently I said, okay, chess have these players: kings, queen, knights, bishops, and rooks, pawns. So maybe I categorize some of the symbols into these categories. So I try to make this kind of a relationship, so it syncs in my mind. So imagine if I'm teaching my kid. So my daughter is 9 and my son is 6-year-old. So if I'm teaching them, and I started teaching them, so my 9-year-old daughter has started learning some exposure into the trading. So she knows what daddy comes into the office and he's doing this. So when she wakes up, um, instead of waking up at 7, she wakes up at 6:30, and she comes to my office and sit for 20 minutes. And I tell daughter, hey daughter, you know the chess game, and I have categorized these symbols. She doesn't know. She just know a few symbols, and I am daddy is watching king. Today's daddy is watching knight. So it's sinking in somewhere. So I'll explain to you how I do that. So there are symbols which are, I call them kings, because they are really king. They have a reason to be king, like Adobe, Autodesk, Broadcom, Booking, Costco, Intuitive, KLAC, Lululemon, MDB, MongoDB. Now, these are very high priced stock. They were little one time. Now they are huge. If you look at their option, they are like $5,000. So I don't want to trade $5,000 option, but I need to watch them, and I categorize them as king. Maybe I can trade the spread, but not the straight options. I don't want to trade these because, and remember, if I trade one contract, the exposure level is so high for that one contract. Exposure level is high. Unless I'm trading weekly, even then the exposure level is high. So I categorize them in kings, and the reason I watch them, because then I can take one of these and then relate it to another stock which is a lower price, which I can trade. So if Adobe is moving, maybe I can go to another symbol. If Costco is going up, maybe I can see other related stocks and see what else is going on into the retail sector. So kings are these high price stocks. Then there is knights here, and so I call them knights. So these are the stocks which are favorite. So everybody's favorite, like Apple, Airbnb, AMD, Amazon, Baba, Baidu, Coin, CRM, SSLR, Google, Tesla. I call them knight. They are easy to read. So they are comparatively from the other symbol. They are, if you're watching them, is easier to read. They have a very liquid options, and they are very active. And one of them is moving. One of them is moving, having a breakout or reversal. Something is going on. So I can go down in these symbols. I can even go down to the tick chart level. The lowest is 5 minutes. I'll explain you the time intervals. The lowest is 5 minute time interval, but I can go down to the tick chart level on these symbols. Then I call other symbols from other. So these are like NASDAQ, and the others are like Boeing, Caterpillar, CMID, Disney. These are not the this is not the exhaustive list, but just to give you examples. So I call the queen. So when I know that I need to watch, if I cannot find any symbol on night, and I flip and see queens, what the queens are doing. So if FedEx is going up, I look at the UPS chart. If Home Depot is going down, then I look at the low chart. So all this, I do that. And then there are bishops, other categories of technology stock, and then there are pawns, the smaller price stock, and then the rooks. So these I categorize: DIA, IWM, QQQ, SPY. We need to know every day where these stand, and the futures market, and the cash market, and the ETFs. And then there is a list of other ETFs which I watch. So you have to watch as to know where they are headed, what is going on. So like QQQ is broke out, and DIA, SPY. So I believe the market is going much higher. So it has a weakness. It was developing, and I was thinking maybe the market is getting overbought, but the last few days the market is saying the market will go much higher. So all this goes on. So this is the trading symbols and other more. Then you have to have industrial groups, so that you can capitalize on based on one symbol, you can capitalize on other symbols. So if Delta Airline came up with the guidance or something, it was tanking. So I said, okay, Delta is tanking. What else I can trade? So I look at the UAL, and it was tanking. So I bought the puts on UAL. And then when I look at AL, so I said AL is going down, but it's a very strong trend in AL. So I did buy the puts, but the next day there was no volume. It went down a little bit, and then there's no volume. So I close it almost like minor gain. So based on the action on Delta, I flip my workspace and I look at all the airlines, and I decide. Now save, I almost bought options on a long on Friday, but I did not. It was trading at $7, and aftermarket is trading at 750. So it reversed. It reversed on Friday. So similarly, the same situation on biotech, gold, silver, financials. So I look at if the financials are moving, then which one I can catch. Oils are moving, then which one I can catch. So all that. Retails, if Costco, I cannot trade Costco, is expensive, then what is going on? So I bought puts on DLTR, and I close on Friday DLTR put. I have another put open on a retail. So all that I flip, because I have the symbols ready, and I look at it and try to figure it out which one is moving. So doing that, preparing it in advance. Now I have a time frame workspace. So workspace is based on these time frames. So I need to have a time frame which I have to look at. So I call it long-term, intermediate, and short-term. And this is the definition of long-term is a time frame, is a monthly time frame, weekly time frame, and the daily time frame. So everything for me starts at the daily time frame. This is where the stock, if it most of the time when the market opens. So when the market opens, it opens on a daily time frame. It is part of the weekly, and monthly is too long for me for swing, so it is part of the weekly. But when the market open, it open on a daily time. I mean, it lands somewhere, and it makes impression on a daily time frame. So you have to look at the daily time frame where it landed when the market opened, and then it can do up and down and up and down, and then you can switch to a 4-hour chart, which is one night. So no, so there are 390 minutes, right, in a day. So in order to divide the day equally into equal bars, so I divide it into 195 minutes. So 390 minutes divided by 2 is 195. And then if I divide that interval, and the lowest interval, which is part of 390, is 13 minutes. So the multiple of 13, 130, which is 10 bar. Multiple of 13, 3 bars. Multiple of 13, 78 bar. Multiple of 13 is 130. Multiple of 13, 195. And the 13 also goes into daily time frame. So the lowest time frame, which means can have, is a 13-minute equal bars. And because I cannot divide 13 equally further, so the lowest is 5 minutes. And the nights, I put it on the tick charts also. So I read the tick charts to figure it out what else is going on. So these are my time frame in a different workspace, and I have a different monitors, a lot of computers and phones and iPad and whatnot. So the whole office is just dedicated for trading. So this time frame goes in the different workspaces, and I'm watching it. Now there is another one concept I want to explain. You see, when we are watching, we get carried away, and the reason we get carried away is somebody is telling us somewhere the volume is spiked 500% on a 2-minute chart or 1-minute chart, or a 40 cents move on when you look at it only on a 2-minute, last 2 minutes, it is spiked 40 cents. So there is something called Ebbinghaus illusion. So it's all relative. So this orange dot, these two orange circles, they are equal size. So what I did, I drew the orange circle first. They are equal size. But when you put a smaller circle outside of orange, this orange looks big. When I put a bigger circle outside of this orange, although they're same, this orange circle looked little. So this is called Ebbinghaus illusion. So what I'm trying to say is that when you are looking at some spike on a 5-minute chart or a 3-minute chart, it looks big. The volume bars look big, the move look big. But then you have to remind yourself, wait a minute, I need to see the whole picture. So you go into these time frames and look at that move compared to a bigger chart, then that move looks very tiny. So then you have to say, no, I need to step back. That move is tiny. Just like if you go into the universe, this Earth is very tiny. And then when you look at yourself, we are like a speck of dust in this universe. So think about that. From the universe, we are like a speck of, like a little dot with a pencil on the paper. That's who we are. Similarly, the trade on a 5-minute chart is like a speck of dust compared to what else is going on. So it may be a little, but we make it a big deal out of it. A 3-minute spike, 1-minute chart, a 5-minute chart, and we make it look big, which is nothing compared to the bigger time frame. So always, if you see something, this needs to develop. If you see something on a 5-minute chart, then it needs to develop on a 13-minute and maybe another 39-minute. Then you have a bigger picture. But if you focus only on a smaller chart, then you're making something very big out of nothing. So this is called Ebbinghaus illusion. So remind yourself that, am I getting that illusion? So now, when we put 4 things together, the U, market, trading system, and trading strategy. This slide should have gone before the other slide. So now this is the core. So think about it, this is core. U, market, trading system, trading strategy, this is your core. So this is your core. Now when we bring the trading symbols, this is the nucleus. So it's U over here. trading systems here, long or short, then you are adopting the trading strategies. You're trading a different kind one set of market. Then you're applying this trading strategy into the universe of your trading symbol. So you have selected 250 symbols. So when you combine this become a nucleus. So this is where you are laser focused. So think about this. If you don't have the system, you're everywhere. You don't know about the market, you don't understand yourself, you don't know about the trading system you're using, you don't know if you need to buy 100 shares or buy one contract, you need to do spread or you need to do covered calls, naked put. You catch one symbol which is trading at 45 cents and you go and buy 10,000 shares because you got the newsletter, Telegram channel or Discord that I'm buying 10,000 shares, 45 cents. That 45 cents doesn't even go to 46 cents. It goes to zero. And you bought 10,000 shares because it looks so cheap. You're greedy and you want to see it going to 90 cents. It doesn't even go to 46 cents. So if you do the homework, so this is your nucleus. So this is where you focus to make money consistently. So think about that. Are we doing this? Maybe not. Now, so all that is good. Now we need to understand the dinosaurs. So dinosaurs can run, but they cannot hide their footprint. So this is what the chief has told me a long time ago. Don't you need to pay attention to the big boys, where the big boys, where they are coming. Sometimes they come with, they don't show the, most of the time they don't even showing you the volume, but the print, the pattern they are putting on the chart. That's what we need to detect. Once we detect that, and others detect, that's where the volume comes in. So the price may be there, the volume is not there, and the volume comes in later, and that's the confirmation that that trade was perfect. So the price plus the volume and the time. So the price, the volume, and the time completes the picture. So at least we need to know what is the price at any given moment. It is the right price. And then what is the volume telling us? So absolute volume, the relative volume. So when you combine this, you can detect the dinosaurs, whether to the upside and to the downside. So dinosaurs are those who are the big boys. So we cannot move the market ourselves. We have to take help from the big. I mean, if the money is not there, you cannot move the market with your 1,000 shares, 5,000. They buy 2 million shares, 5 million shares, and like that. So who are those people? They are institutional players, hedge funds, sovereign funds, pension funds, high frequency traders. They have immense size and influence. They have a program trading. They unleash the program. The order is given to the execute trader from the big boss. The big boss is telling his deputy, and the deputy, uh, even the deputy doesn't know why the big boss is telling him to buy 5 million shares. And the big boss, he gets some inside tip, insider news. He gets it that this stock is about to move. There's a positive news coming, and he orders his deputy to buy 5 million shares. And his deputy know that if big boss is telling him to buy 5 million, he has a reason. And who am I to ask? So what he does, he tells his programmer. The programmer unleash the program trading for buy. So he's buying 100 shares, 200 shares. He's giving order that by the time the day is over, you need to buy 1 million shares very tight. Little by little, 1 million shares, and you have 5 days to fill 5 million shares because the big boy boss know that on Monday the news will come, and by Friday he needs to position you know, his position. So 5 million shares need to be bought in 5 days. The junior guy who is just buying it, he has no reason. He doesn't know the reason why he's buying. He's just buying it, and he gets bonus for filling that 5 million order at a given price. So there's a program trading kicks in, and he's buying it, and we don't even know that this is going on. And they may have a complex trading strategy. So they have the money. Think about the Ray Dalio and Tudor Jones and all the guys out there who are making $1 million of trading, $1 billion hedge funds. So all that is going on. So somehow we need to detect. So sometimes they show they are in a hurry to buy, and sometimes they are very slow and they hide. They do the dark pool, etc. So we don't even know 1 million shares traded in the dark pool. Somebody on the other side does the transaction, and then he has to cover. And then he comes in the regular market and he start buying it. So you may see it in the regular hours. So price and volume filters. So we need to have some kind of a price filter, that some kind of alert, some kind of a volume filter. 1 million, show me only the trades which are moving 1 million and above. Show me the trade which are moving price of $15 or more. Or if you have done the analysis on your, so these price filter is valid to catch the new symbol. Because if you have done the homework for prepare the basket, you already know that you have qualified that those symbols based on the price filters. You have already qualified the volume filters. But during the day, you are filtering further, that when the volume reaches 1 million, then I get the alert that this one has reached and it has fulfilled this criteria. When the average true range is $2 and is trading at $1.50, so it's almost reaching its average true range, I need to see it. If any spike, so you get the alert, and you have to remind yourself, Ebbinghaus illusion, am I seeing this price spike? Is it an illusion and I need to compare it on a bigger chart, or am I looking at a 5-minute chart and I'm making my decision? Because the 5-minute chart spike is nothing compared to the time frame on a daily chart. And same for volume. So volume spike on a 3-minute, 5-minute chart is nothing compared to the day chart. It's just illusion. And then there are other filters, intraday high, intraday low, percentage up, percentage down, resistance study, the support study. So you must have a way of identifying the support and resistance. Develop the skill to identify where is the support, where is the resistance, what moving average makes sense. So all that goes on. And volume analysis, whether the volume is trending, whether the volume is a climax, whether the absolute volume is making sense, what is the relative volume. So all that goes on. And then, so the trading system I explained to you. So there are 12 trading systems I use, and the main one, so there's one, there are actually 13. Is not listed, is a candlestick pattern. So there is 130 candlesticks. So the candlestick, the art of reading the candles is very important, because the candle tells you the story, and the little candles are more powerful and gives you the clue compared to the big candle. Big candle is just a big bar. It shows their big size, but it's the little candle which tells you a lot of stories. And the candles not only just in isolation, but in the relative to other bars or candles, and what else has happened. So these are the 12, 13 systems I explained in detail in another session. So when I'm teaching next time, I'll send you the notification. You can come and attend. So all these 12. So you have to work on this. And the last is, when you're developing those systems, you have to, there is a belief, a checklist of beliefs, a checklist of trading beliefs. These I listed here. So I like to trade using fundamentals. So I like to trade with technical analysis. I like to trade with the trend. So what is your time frame? I like to trade against the trend. So all these beliefs, you have to ask yourself, is this useful belief or non-useful belief? So there is a big exercise you need to do, and get rid of non-useful beliefs. If you are trading based on certain beliefs, is it making you money or is it useless? So think about that. So do this. So I listed, there are 3 slides on it, and I explained some other time in detail. So we skip that. And the last, so when you put everything together and you're developing your system, so when you're developing your system, you're developing it based on your belief. So you see all that 12, 13 system and all the thing I told you about the core, about the nucleus, you formed a certain belief, and now you are trading it. So this is the matrix. So there are 9 quadrant. So think about it. These are the 9 quadrant, and I will explain to you these 9 quadrant. But then first you need to look at the vertical bar and the horizontal bar. So pay attention to the vertical and pay attention to the horizontal, and then there are 9 quadrants. So the way it is called belief, market condition, and reaction. So our reactions in the market is dependent on our belief and what is going on in the market. So think about this. If we develop something and we learn something and we know that this thing works, So think about this. So either you have a very high belief that this thing work, or you have a low belief, or you have a medium belief. So you just you pass the low conviction. Now you have a moderate belief in that whatever you learn, acquired skills, etc. over the time, you got the training from someone, etc. Yeah, I have a 1-year coaching program. If you're interested, you can send the email and inquire about the 1-year coaching program. So I go into this is just one session. I explain in detail and technical analysis over the 1-year period. So believe in trading system, low, medium, and high. Now, on the vertical bar is the market conditions, challenging, difficult, and favorable. So think about this. If you have a low belief in the system, you just learned something, and the market condition, it so happen you, a lot of traders, they come in the market when the market is bullish, okay, it's moving, everything is looking good, and everybody's talking about Tesla and Apple and AMD and Nvidia and you go on CNBC and Fox News, and everything is looking good. People are talking, and your nurse is talking, and your Facebook buddies are talking, and you go to the restaurant, and the waitress is talking. You mention something. I'm a trader. They ask you, what do you do? Oh, I'm a stock trader. Really? Can you tell me something which I can buy? I heard that this thing is looking good. Should I buy? So when you, and then the person learns something. So he adopts or she adopts something. So he has low belief right now, and the market conditions is looking very good. So the reaction of the trader, he becomes or she becomes overconfident. So think about that, overconfident, because this is so good, and I should buy more of weekly options in Tesla. So open an account on Robinhood, and I keep buying Tesla weekly options because Tesla is on the run. So market belief is low just now. When the market condition is favorable, become overconfident, and then when the belief is making money, and the belief is turned into medium level, so we have some conviction, we have seen some money, so is and market condition is favorable, so we still go into the tense mode. So we are in a tense mode, and we are, when we are investing, the exposure level, we are mindful of our exposure level. And when the belief in the trading system is high, we know it performs very well, and we have the data to back up. When the market conditions is favorable, I'm kind of relaxed. So I'm relaxed. And even when the market conditions turn into difficult, I am confident that I have seen it, the market conditions difficult, and I survive because I have a high belief in my system. So I become confident. And then when the market conditions turn into challenging, like choppy, one day go up, one day go down, I am patient. Why? Because my belief is high. But if my belief is not high in a challenging market condition, I start to become skeptical when the market condition difficult. When the market become challenging, I start modifying the system. That's where I go and modify this indicator and that indicator. I buy another indicator. I change the moving average from 20-day to 21-day, or exponential to simple moving average, and crossover and this and that. I tweak. I start tweaking. So what happened? Because I have a medium belief, I'm not patient. I'm not patient. I start modifying. And when I just started and using that system, and when the market conditions become challenging, I abandon the system. I just dump it and go and look for another shiny object, because I did not develop the skill or the mindset to use that system. And maybe that system was not fit for that market conditions. So that system was not fit for that challenging market conditions. So it was giving me fake out. So imagine this, the system you bought was a trend trading system, and the market become choppy. So if you learn the techniques to use the trend, so you learn, okay, if you do the connect two dots, higher high, this is a trend. So you say, okay, So I see this higher high and I draw the trend line, and this is a trend, and I go by. And because the market condition is challenging, is one day it goes up, one day it goes down, and you're not aware of, and you don't pay attention. That trend system, plotting the line high, two highs doesn't work. Next day it goes down, or trend line, it gaps down on the other side of the trend. So you abandon the system. So this is what's going on based on the belief we have and the market conditions. So think about this. So I explain all this in these three charts. Now, just a second. I have to explain this. So same way, there are other mental states we adopt depending on what kind of market conditions we have and the skill level we have. So if the skill level is low and the market we are facing the difficulty, we develop apathy. When a medium difficulty level turns into medium, we worry. We become a worry person. There are people who are always worry kind of people. So doesn't matter if the condition is good or bad, worry, worry, worry. So always worry. So worry or develop high anxiety because the difficulty level is high and we have low skill. So when we have low trading skill and the market condition is difficult, we develop anxiety, even arousal. But high skill level, we are relaxed, we are in control, or we are going in the flow. So same market condition, same difficulty level, but depending on the skill, we go into a different mental state. So on one hand, our skill level is low, we are into this mental state. Market condition is same. So there are two traders. One have a low skill and one have a high skill. And the market condition is same, high, medium, or low, the conditions. So the one which has a low level skill, he's creating anxiety, and the person who has a high skill, he's going with the flow of the market. He understands. So think about this. There are 9 different mental states depending on the skill level and depending on the difficulty level he is facing in the market. So think about that. Then the last one is the competence level. So same, the market condition is challenging, difficult, and favorable, and the competence is either low or high, and in between is medium. So when the market condition is favorable, like Tesla, you cannot go wrong buying Tesla weekly option on Robinhood, even though the competence is low, because the market condition is favorable, you become optimistic and you go all in Tesla. One trade after the other, one trade after the other. So favorable, optimistic, no competence, buy Tesla weekly option. When the market conditions become difficult, you get confused and you say, what happened now? No, 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 it will come back. It will come back. It's just a dip. I'm not getting out. I'm not exiting. It will come back. I'll buy more. So confused. And then when the market condition challenging, the Tesla keep tanking, you're fearful. And we know that position is going all zero, fearful. Whereas if we have a high competence, same market condition, we are relaxed, we are focused because we have done the homework. So we have done the homework, we are relaxed, we are focused, and we are confident because we have done the homework about the exposure level, about developing the system. We are laser focused on the symbols we trade, the strategies we have. We are aware of our portfolio size. We are aware of our skill level, what we are trying to achieve. We are aware of our limitations and all that. So we have a high competence. Even though market conditions are challenging, we are confident. So think about this, what we go through. And then final is this quadrant, which put the numbers. So what happened? We stop trading if our belief is low and market conditions become challenging. We abandon the system, or we stop trading, or if we have a high belief, then we are patient. So either we are abandoning the system when the market is challenging, or we stop trading. And then when the market condition is difficult, we start ignoring the signals. If it's telling us the exit signal, we ignore it, or we start modifying the system. And when the market condition is favorable and we have a low belief, we just got introduced into the system, we become overconfident, we overtrade. When we have medium, then we are relieved. But if we have a high belief, then we are either relaxed, confident, and patient in the challenging market. So these are the 9 quadrants. And finally, I'll explain to you a little bit about the swing trading. So we have the main service we have is a swing trading. So swing trading is a speculative trading strategy. You trade active markets. So we trade active markets. We trade liquid markets. We trade the market in the news. So it always something has to move in order to make money in the options. Swing trading is a combination of two concepts, the long term and the short term. So it's 1 to 7 days, quicker pace of day trading, slower pace of investing. Objective is to maximize the gain in the short period and minimize the downside risk. Now, profitables in swing trading, the profitable trade comes before the crowd notice. So you spot something is about to happen, and it happens once you put the trade, and you know that this thing is about to move, and it moves. So fortune, and remember, the fortune is made by a singles, not home run. So home run just take care of the failed trades, and the equity curve should be rising in a smooth. So if your equity curve is rising in a parabolic fashion, then your exposure level is very high. Something is wrong in the market, or you are over trading. So think about that. So in swing trading, when you trade stocks, you make 3 to 7%. But if you convert that into option, it's 40 to 100%. So there's somewhere your profit objective is between these this range. Now, executing, so anticipate the next move to get head start, understand the price reaction. So understand the price reaction, then not only the price reaction, but the volume needs to come in. When the volume comes in, then you know you are right in that trade. Understand the buying and selling pressure. So there's another session I have on volume analysis and the buying and selling pressure, and understanding the support and resistance, what kind of players participate when the support and resistance, and how are you what is going on when the support and resistance are built, and the static support, the dynamic support, the participants in the creation of support and resistance, and the turning points. So all that goes on into swing trade. So in swing trading, all that what I explained to you goes on. You don't need a perfect indicator. For the perfect indicator, it's not a swing trade. It's a long-term. Perfect indicator will give you the indication for the long-term trade. So if you're looking for perfect indicator, when that indicator give you the signal, you buy based on your belief, and then you hold it for a long time, because the perfect indicator is late, and the perfect indicator is made up of price and volume. So trade the system fitting your trading style, proven pattern. So I explained to you, same techniques every day, same trading system, same trading strategy, same symbols, bunch of symbols every day. Expertise, judgment. So this comes over the time. Be flexible. So I explained about the flexibility in a different session, but you have to be flexible. Understand the broader market. So I explained to you about the market analysis. Every day you have to do the analysis of the market top down and bottom up to understand what else is going on, the strength and the trend and the volatility. And this way you stack the odds of success in your favor. So real trades are sent in the real time. So when we spot the trade, we send you in a real trade at that time, not something overnight that on Sunday I'm watching this and get my trade and then buy something out of this. I give you 10 symbols and I say, okay, one of these you buy. So one of the out of 10, something will move and the 9 will go the other direction. So you know it's useless. The Sunday night trade is useless. You get the real trade real time via email and telegram. I give you specific buy, I give you 3 targets and a stop. I explain the fundamental on my blog post. If you go to Trade Genie blog post, or if you are following me on um, where Facebook, so I have a Facebook page. I send you the trading system guidebook. I explain via webinars. I also hold, sometimes I hold a short session, like a 30-minute session during the market hours. If I'm free, I show you the charts. So I did that last Tuesday and explained to you all that. I have an Instagram channel. If you can find me, The Real Trade Genie, or a YouTube channel, The Real Trade Genie. So there's no shortage of trades. Every day I send you. And the price, if you're going for the yearly, then it's 1897. If you're going for monthly, it's 197. So you can go to the website and enroll for 197 per month. Or if you are signing up for the year is $18.97. If you need to contact someone, talk to somebody and help you out, this is the number 212-930-2245, or send me email or my team. There's always somebody, even on Christmas Eve, somebody is working in my team. So there's a 24-hour support for you. And I hope I taught you something meaningful. And I'll see you. Today is Sunday. Today is Sunday. Yeah, today is Sunday. I forget what day. So today is Sunday. Most likely I'll teach you again on Tuesday. So till then, say goodbye, and I hope to see you on Tuesday and tomorrow. If you are a member, you will hear from me in the morning. God willing. Thank you. Bye.